Hey everyone, welcome back to the channel. I'm Doug, the retirement guy. If you're like me, you love the idea of weekly dividends, that steady cash flow hitting your account each and every week. But before you jump all in on weekly ETFs, there are some common mistakes that investors make that can really hurt their returns. And today I'm breaking down the 5 biggest mistakes you can avoid when buying weekly ETFs. Before we get into that, let me just be a shout out to all of our Patreon supporters. I appreciate each and every one of you. We are trying to get as much information out there to you guys as we possibly can. And we want to thank and welcome all of our new subscribers. We would love to keep the thing going. So if you're not part of the club, hit that button, hit that bell notifications thing, and just get notified every time we put one of our videos out. Let's get into today's video. Notice to all viewers, past performance does not guarantee future results. The information provided in this video is for educational and informational purposes only. So if you need any financial help, always contact a financial advisor. The number one mistake that people make is they don't do research. When I started off in investing, I was number one with this. I was just jumping in and grabbing and going and thinking I'm doing everything right. Just because something is on the news or a popular website, or you read it on, Reddit, or you saw it on YouTube, it doesn't mean it's always right for you. Make sure you understand the fees, the minimum investment, and if there are any restrictions before you buy. Now, I just pulled one up here. This is Roundhill, MSTW. Now, I'm not picking these guys out for anything particular, but here's a prime one a lot of people talk about. A lot of people have been saying this is the future, this is great. But do you know what the expense ratio really is? 0.99% is what's advertised, but do you know what the real number is? Do you know what tax system do they use? Are they using the ROC or are they using something different? What are the holdings? What are they actually getting into? So many of these things are using synthetic calls, and they're using, they're not buying the funds, they're not buying the shares, and then they're selling puts and calling, cover calls. What kind of strategy are they using? So all this stuff is what you have to look at and know before you just jump in and say, hey, I heard this was great, let's buy it. So it's kind of a big thing. I know I did it when I was at the beginning, but now, that's why I created this channel, is because we do so much research on every single fund as we go out. How does it fit your portfolio? This is another big one that no one ever talks about. Just because it's on that news and in that website, does this fit you personally? I just talked to someone on the phone about this, and in one fund, they got QQQI, and then the other one is he wants to add SPYI to the fund, and I said, do you realize you have two heavy technology funds? You're trying to put two big technology funds. How does your rest of your fund look? Would this actually fit? Sometimes this will fit. Sometimes this is not right, because you put these two together, you're talking almost 80% in technology. Is that what you want? And so this is why we just always talk about this and say, how is this going to fit your portfolio? Do you know everything behind it and what's going on? Number two is chasing the yield only. Chasing the yield, it's tempted to go after those high advertised yields. Sometimes it's 30%, sometimes it's 50%, sometimes I've seen 100%. But remember, high yields often come with high risk. So instead of looking at the percentages, which if you understand percentages, if the price of the fund goes down, the percentage is going to go up. If the dividend goes up, the percentage is going to go down. So the number is actually a little skewed one way or the other. Check the strategy behind the ETF. If it's suitable, if it's for short-term play, long-term play, what's all going on with the fund? Don't just grab, oh, I'm getting 50%, 100% on this fund. It's all great. Here's the one I'm going to use. This is a very, very popular one out there, and probably most of you have this one. ULTI. It's the Ultra Option Income Strategy from YieldMax. Now, right off the bat, from March through September, this one here advertises or promotes a 47.35 actual dividend yield. If you go to their website right now, it's going to say they're doing 85%. You take a look at some of the other websites, they're talking 115% because they're calculating things totally different when this was a monthly pay versus a weekly pay. They're just taking a calendar over the past 12 months. You received X number of dollars of dividend and you're paid so much. So you really got to do this and find out what is your actual real yield on your fund. So we put this through here and said, look, from March to September, what would we have collected? That's 47.35%. But now you got to talk about the NAV erosion. So from March to September, you've lost 17.58% in NAV erosion. So realistically, your true dividend from March to September was only 29.76%. Now, of course, that's a great number, 29%, but how many of you always sit there and say, wow, I'm making 47% on this dividend? If you look at your Charles Schwab, your Fidelity, if your accounts, they will give you the dividend yield on the products as you get the dividends paid in. So their numbers are all over the place. So you better understand how to figure out what the true yield is versus just grabbing something like right here. I love ULTY and I've invested in ULTY. But if someone come to me and says, I'm making 47 on ULTY, I'd have to sit there and say, well, what's your NAV erosion onto it? What have you lost, in the price of the fund? Or, what's going on? And so this is what you want to always do. You want to know what your true bottom line, your true yield is, and your total return, what you're getting from the fund before you just jump in and grab everything and anything. Because what you'll have is nothing at the end. Number 3, not understanding the strategy. Now, I'll be honest with you again. When I first started this was all over my head. Option calling was all over my head. I didn't understand one single word they were talking about. I didn't understand puts versus calls. And we took a lot of time and to learn all this. And before I would even try to help anybody, I said, I have to know every working detail of it. And I've read the books, I've watched the videos, I have done everything you can. I've talked to the experts, so I can talk like this and I can understand what's going on. So not understanding how an ETF generates income. Many weekly pays use option strategies like covered calls or spreads. And if you don't know how these strategies work, you may be shocked when markets swing one way or the other and your funds behave differently than you expected. Again, we go back to the ULTY. This fund generates income via option premiums, dividends from direct held stocks, and treasuries. Okay, did you even know that? Did you know where your income comes from? Now, this thing also does, it's that options premiums. It's doing the covered calls. It's doing covered puts. It's doing a lot of different things in the option strategies. We use another one, YMAG, a Magnificent 7. A lot of people own this one. And did you really know that they use a synthetic cover call on this one? Do you know that they really, in a lot of cases, don't always own the Magnificent 7? So they're doing things differently. And the question is, do you know the difference between a synthetic call and an options-based call? Do you know these different things? This is the stuff you want to research a little bit. And then you want to know, if someone is selling something in puts, what does that mean? Or if they're doing calls, what does that mean? And these are things that are really confusing at times if you're a brand new investor. But even the old guys don't even always know exactly what this means. That if a put, it means they're selling it on the sell-off. That means they're putting a number lower than what it currently is because they feel the fund is going to drop versus cover going above. So there's so much you need to understand in the strategy of the fund, so which direction it will go. So don't always rely on someone else to know it. Always be the man who's the smartest guy in the room knowing this stuff, but always listen. Number 4, over concentration, not diversified. Mistake number 4 really comes into here is some investors load up entirely on weeklies. I've seen it. People commented it. I am not picking anybody out. Everyone up, they'll let you do what you want to do. But I hear so many people sitting there. I am retiring on one fund, ULTY. I'm retiring on one fund, Salty. I'm doing this. I'm doing that. They're loading up on one fund only. That's basically putting all your eggs in one basket. If you do that, you're putting your money all really in one strategy, which is extremely risky. This is why we always say diversify across monthly, quarterly, growth-oriented funds, and it'll help you protect your income stream. And this is something I put down here, and I just threw this together real quick for the video. And this is nothing that I will tell you this is exactly how you do it or what I've done it. But I have a category in my portfolio for high yield weeklies. And there's only a certain percentage of my total portfolio can be in weeklies. And then I also have the high monthlies, which is why we started that second channel. If you guys don't know about it, look on the YouTube and you'll see Doug, the retirement guy with the monthly ETFs, because we broke these two down because they're so big. They make up majority of the marketplace nowadays. So don't be afraid to look at that one. I know it's a little advertisement in the middle of a video, but you know what? It helps everything out because both of these are huge. But then we also have funds. I have funds out there that are designed strictly for growth. I'm not looking for income. I'm looking for additional growth so that I can get additional funds to put it into the weekly category and to put it into the monthly category to generate more income. But I'm trying to grow the trees. And then we also have another one that's income for the REITs. I break mine down doing REITs. I love REITs myself. I love that the housing. I love the office buildings. I love the warehousing. I love the tax advantages for it. I just love everything about the REITs part of it. Now, they're not going to pay, 15, 20, 30, 40% dividends. They're going to pay solid dividends in good times and in bad times. So that's why I have a section over here for it. And then I also got bonds. We got a lot of different things in the bonds market. So you just go through and you put a certain percentage onto it. Think of a piece of a pie. You break it down accordingly. You put things in each fund. And then you always want to diversify. You want to make sure you're covered. The simplest one I tell everybody is if you had everyone pretty much has a kitchen table. Go look at your kitchen table. You probably have 4 legs on it. Take one of those legs off, what happens to the table? It'll tip over. But if you take a table and put 5 legs on it, 10 legs on it, and you take one of those legs off, what happens? The table will probably still stand. And that's the same scenario here, is that we're trying to build a table that will stand in good times, bad times. Technology takes a dump, all of a sudden, you're okay. If the real estate goes in the trash, I'm still okay because it's only 15% of my fund. Now, number 5 is forgetting about taxes and fees. And this is the final one. Forgetting about taxes and fees, weekly payouts sound nice, but remember, those dividends are often taxed as ordinary income. Plus, many of these funds have higher expense ratios. So always factor in what will keep, after taxes costs down. So what I want to go through with this one, just give you guys a quick synopsis of the tax side of it. Now, we talk a lot of this when I do a lot of the videos, we talk about tax things and we talk about the return of capital and all that. So we're looking out for you a little bit on this, but you got to always understand it yourself. 1, qualified dividends. This is taxed at long-term capital gains. You would love to have all your funds qualified. That means you're basically what your tax bracket will be is you're either going to be 0, 15, or 20% in the long-term capital gains. The second one that's very common and more common across the board is what they call non-qualified or ordinary dividends. These dividends don't meet the IRS qualification rules. They're taxed at regular income, same as wages. So this could be almost up to 37% in taxes alone. Now, number 3 is the one that we talk a lot about on this channel, and because it's such an interesting piece, and I will tell you, a lot of the weeklies are switching to this or have already been part of this, but you have to understand it. It's not actual income. When you see something return of capital, or you see someone say we're doing distributions, 99% of the time when they say distributions, they're talking about return of capital. So because it's not really classified, this is the fine line and piece to it. It's not actually income. It's a portion of your own investment being returned to you. And this reduces the cost basis and it defers your taxes until you sell. This is very common in high yield ETFs and the CFs. Now, we did, again, a video on this one, explains it, I think, extremely well, takes a very, very simple step and explains what ROC actually does for you, how it's advantage for you. So look at that. I'll try to put that down in the description also, but watch that video so you understand what return of capital actually means. And then the fourth big one is Section 199 of dividends. Now, this is primarily for the REITs. I put this in there, like I said, I do a lot of business with the REITs. I enjoy those things, but there's special deductions allowed that investors can take, a 20% pass-through deduction. It applies to a lot of REITs on that. So when the Mr. Taxman is telling you pay your taxes, the number one thing I tell you straight out is ask an expert. I admittedly up front tell you I am not an expert. And I do have a CPA on file. You always use a CPA with this stuff. And I do ask them at occasional. That's how I knew about Section 199A. That's how I've learned about the return of capital onto it. So I always tell you guys, ask an expert when you get into taxes. Don't watch a video. Don't watch a YouTube video and think you know everything about it, because these things change every year and all the time. And even the ETF companies don't always, they're looking at the rules and they're always going to make changes accordingly. So investing can be fun, guys, but it can be also involved. So there you have it. The 5 biggest mistakes to avoid when buying weekly ETFs. Keep in mind, you're set yourself up for smarter and more suitable income if you avoid these 5 mistakes and just take your time with it. And I'm right now 59 years old. I have been doing this since I was 27. And, when I was younger, that's why I say younger, in my late 20s, early 30s, man, I thought I knew everything and I didn't know anything. But over the years, I've learned and how to build a portfolio very, very strong and very well. That's why I started doing the YouTube channel. But it's fun, but you can be involved. So enjoy it, learn from it, and don't always grab everything at the top. Guys, if you found this helpful, hit that like button. It's Doug the Retirement Guy. If you like what we're doing, hit that like. Hit the subscribe if you're not there. And also, leave any comments out there. And if any of you can support us on Patreon, we'd appreciate it. We'll see you next time.